Tell me, Adela, how long have you been profitable?
I've only been profitable since about January of this year. And when I say that, I have to disclose I'm not nowhere near profitable yet, because in the previous years I have lost a lot of money trading. So when I say profitable, I really mean by starting to trade in Forex specifically.
And how long were you trading before?
I started trading in 2020, during or right after the mini crash we had, in March. Um, so I think it was May when I actually started trading.
Interesting. So it's been about a little over 4 years since you started trading, and so far you've had what you would call consistent profitability for the past 9 months. Um, a lot of people, they really wonder about what is that transition? What is the quote keys to the kingdom? What are the things that move someone from either a losing or break-even trader to a profitable trader? And for you, I'm sure there is quite a long list of a bunch of things that all contributed to you becoming profitable. If you could pick out something close to the top of the list as to what you think is one of the most important things that caused you to move from that break-even losing profitability into actually being profitable, what would one of those things be that contributed to you getting profitable?
I'm learning bad habits and practices. I think that was key, um, because when I started trading, I didn't do the hard work. I didn't sit down and do the things that traders who are serious about this profession are doing. I jumped in because it was a thing to do. It was something to do in 2020 as we were on lockdowns and whatnot. Um, so I approached it in a way that most people who got into the market did at the time. I started following some YouTube videos um, that are not true to what trading really is. And I learned a lot of bad behavior because of FOMO, greed, fear. I would base my trading decisions off of all of that. And there were things that I just needed to correct in order to get profitable. And I think that's the one main thing that I can talk about. And of course, there's a lot of little things that go into all of that. But really just correcting all the bad things I have learned over the last few years was the key.
You say bad things. To a lot of people, bad things might be a super subjective term. So let's hear an example of one of the bad things that you were saying you were, quote, doing that was bad or wrong or not working, and what you changed about that, quote, bad thing to sort of get it out of the way so that way it could contribute to you becoming profitable. What's an example of one of those bad things you solved?
So, uh, well, first of all, I didn't really plan my trades ahead of time. I would get in just because it was maybe something I saw on social media or on a YouTube video, or just because um, I would look at charts and without really understanding all the technical analysis behind it or what to look for in a chart. I didn't look at any indicators. I didn't look at anything at all. I would just see something's going up and I would just take that trade. Like I said, I was a real ignorant person at the time. And I really got just lucky when I started trading in 2020 because um, I was buying dips and it was working because the market was going up. So that gave me a false confidence that I knew what I was doing, whereas I literally have just gotten lucky. So nowadays, the way I prepare for the market is I look at, a technical analysis. I look at some indicators, and I plan my trades ahead of time with really a big question in mind behind every trade I take. And that is something that has shifted over the years as well, or in the last at least 9 months. I used to think, okay, if I enter this trade, how much money do I stand to gain from this trade? And now that has turned into a question that is, how much money can I lose if I enter this trade and things go against me? If that makes sense.
I'm going to try to summarize what you said. So essentially, one of the quote bad things that you say you were doing was that you weren't really planning your trades, meaning you weren't really giving a lot of forethought to what could go wrong, essentially. And so, what you started doing to rectify that issue is that you started actually being more concerned about what the risk is and how much money you stand to lose, or where your stop loss is, or what the total risk is for the trade. And then you focused on that. And then whenever you win, cool. Sometimes you'll win, you'll have big winners, small winners, break evens, whatever. But you started really defining and getting very specific about how much you were risking. Does this characterize that issue?
That you summarized it very well. That's exactly what I have started doing.
Okay, cool. So for those of you watching this video, if you were in a position where you are just getting into trades, giving zero thought whatsoever to what the risk is, you're just entering a fixed position size. You have no clue what you're going to do if the trade goes wrong. Perhaps you're only even focusing on how much you could make if you're right without caring what's going to happen whenever you're wrong. One thing you could do is to really start being more clear about what you're actually risking. Now, this is a very fun conversation I want to get into because Adela, while you are still clear about what you're risking, you are a person who adds to losing trades. Is this correct?
Yes, among other things, I do that. Yes.
So one of your risk structures is adding to losing trades, among a few other ways of managing risk. So what I would like you to do is to explain to me and the rest of us here, how are you able to still control risk while adding to losing trades?
Well, the way I think of it is every single entry that I take comes with a certain risk. So I will assign appropriate risk to each trade, and I will look at each trade as a trade that stands on their own. So even if I'm adding to losers, I'm looking at the single entries as single trades. Therefore, each and every one of them comes with my pre planned risk. And once I have exhausted that risk, and if the trade does not work out, I just close individual trades based on where I think they will go in the future. And that might sometimes mean that I will close all trades if I'm not convinced that the trade will play out, or I might close the trades that are in biggest drawdown and I let the other ones play out.
Okay, so it sounds like you have a dynamic way of doing this. What I'm trying to do is I'm trying to conceptualize this in a very simple way so people can understand. Let's say the market has gone up to a specific area that for some reason you personally think it's going to fall to the downside. And so you enter a sell position. Let's say, for example, you're trading like you do on a prop firm. And let's say that the prop firm has a $100,000 balance. And let's just say the max drawdown you can incur is about $10,000. Tell me how you would go about structuring that risk for that trade, position sizing, how you would calculate it, how you would go about determining if you were to add, where would it be? just walk me through the whole process that you would use to structure a trade. And while you walk me through the process, I'm going to draw it on a trading view chart just so we can kind of visualize it. Ready?
Sure.
Okay, go for it. Just start explaining it.
So on $100,000 account, my risk for each entry would be $500. So it's hard for me to, on top of my head, calculate that into a position sizing, just because different trades carry different margin, and they the position sizing is very different. So I would use an actual calculator to go in and calculate what that $500 risk translates into when it comes to lot size.
Okay, so I mean, let's say you enter right here. We'll just use a little horizontal line. Let's say that's your sell position. How would
Mhm.
you go about determining like what does $500 of risk represent? And how would you determine a specific price and then a specific lot size for if price gets to that location, that'll be a $500 risk. And if not, how would you sort of structure it? Just walk me through what you'd actually do.
So I will look at a trade, and before I do anything else, I will try to draw potential um, or draw lines where I think the trade might end up going or the price might end up going, for additional entries.
Okay, so
I will,
I'll just put some random locations here. We'll say, you're
sure.
gonna sell right here, and
Mhm.
if you're wrong, let's just say, for example, you'll maybe add here, maybe that's a resistance zone, or maybe that's just a higher high, or whatever you think. Let's just say you'll add here, and then you'll add here. So visually, we're looking
Right.
at this. Your potential entry would be here, and these are your potential additional trades. Now, what's next?
So then I will find an invalidation point for all of them.
So an invalidation point for you, does that mean that's just a location you're going to close everything at a loss, or does it mean something else?
Correct.
So I'll just use a trend line here. We'll just say this purple line, just to keep it simple, that's the final invalidation point. So worst case scenario, all your initial position and all your subsequent entries will end in a loss right there if that occurs. Does this look good so far?
Yes.
Okay. So whenever you're structuring your risk, how would you go about determining what position size this should be and how to actually assume that $500 risk? Just walk me through it.
So for that, I will use a calculator, right? Babypips.com is the one I use. So I will just enter, all the details in there, and without uh, knowing what each of the trades, I wouldn't be able to calculate this on my own without a calculator. So I just use that for the ease of things, and I will put in that from that point, from that first entry to the invalidation, that will be a $500 risk right there.
Okay, so on this chart, it looks like it's a little over 500 pips. Let's just say for simplicity that this is 500 pips from the first entry to there. And let's say you do the calculation to find the lot size, and the position size calculator tells you that using a zero point 0.1 lot would represent $500 of loss if it goes to that invalidation. So now you have that position, and this risk is defined. That's the worst case scenario. You enter this trade, price goes up against you, and then it goes to that final invalidation, and then this specific position you entered represents a $500 risk. So now we've defined that first position. You showed me how you define your absolute loss. That's $500, which in this case is about 5% of your total loss that you can assume on your funded account. Walk me through how does this work? You add to these losing trades, like the risk is obviously going to increase, but just walk me through how it would work. Say this first position goes into drawdown, that would be in like, maybe $150 worth of loss at that point. How would you go about starting another position here, like adding to the loss, and what position sizing and how would you do the risk for it? Just walk us through it.
Okay, so I would add an entry that now will probably be a little bit bigger in sizing, just because it is now closer to the invalidation point. So the $500 would go a little longer way at that point.
So
So
you're
it would be an additional $500 risk to the invalidation point, but the sizing has now changed because there's less distance to get to that invalidation point.
so instead of 500 pips, we'll say this is like, 350 pips or whatever. So if this was a zero point 0.1 lot size, this might be something like a 0.15 lot size. And what you're saying is that if that second position goes all the way to the invalidation, that will be a $500 loss. And
Correct.
meanwhile, that first position will also be a $500 loss. So you have effectively just increased your risk from $500 of risk to $1,000 of risk. This is all true?
Correct. And I do that because, again, I try to look at those additional entries as a standalone trade.
So
So
you would,
instead of labeling it as I'm averaging into my trade at this point, I just think of it as a single trade or an additional trade.
okay. Um, as a little side note here, would you be a person who says that you believe it's true that the further the market moves in one direction, the more likely it is to revert and turn around?
Correct.
Okay. So in this case, even though through your lens, the mental narrative you tell yourself is that it's each a standalone trade, however, your total risk on the basket of the multiple positions does increase with each trade. And just as another quick side note, how would you respond to somebody who tells you that this is just gambling and it's just risky and this is a ridiculous thing to do to just continue adding more trades all the way to a potentially huge loss? What would be your response to something like that?
Well, every single time we enter a trade, we are assuming a risk of losing money. That is just what trading is. Um, Over time, with experience, I think we gain a better idea of what the market will do, and not just based on one strategy, but rather based on different things we keep seeing happen in the market.
Okay, cool. Well, we'll run through a couple scenarios here. There's three scenarios that come to my mind, but we'll do it just to see how you manage it. Let's say after the second entry you've added, the first position is in minus 150 of drawdown, minus $150. In this position you enter, and then it goes back down here to the first position. I know this is just coulda, shoulda, woulda, and I know this is just back testing, and I know this is just the, you know, all, hindsight is 2020. However, in a situation that is similar to this, what do you think that your decision would likely be to do if price just turned around from your second entry, then went back to the first entry? Would you hold? Would you close these both positions at the same time, take a break even on one, loss on the other? Would you add? Just walk me through what you might be likely to do if you get into a trade, goes into drawdown to your second position you add, and then it goes back to the first entry. Well, what would you do?
So I will at that point look at the market and see if I think that my trading idea is still valid. Meaning I will have a target, right, that I thought the trade will end up in. And once we have a move like you just have drawn, I will look at the market a little bit more zoomed in And if at that point I'm not seeing anything that tells me that I should be getting out of that trade, I will just leave it alone.
Okay.
And I know this is really hard to explain to other people what exactly I mean when I say, if the market is not convincing me to take action. Um, that part comes with experience, and seeing things over and over again. And I really try to let the trade play out. Um, and there's only a few things that can convince me otherwise, and that is if the overall market has changed because of an external stimuli, such as did we get some news that might be interfering with my trading idea, or I don't know, it could be something like a world event that could be changing that pattern. But if I don't see anything that would make me close that trade, I will just leave it alone until I get an alert that this trade is approaching my target. So I
Okay.
try to enter trades and leave them alone, basically, as much as I can, to not interfere and to avoid getting out of them early, or even adding to my trades too early. I find that leaving it alone and taking the approach of hands off, if my risk is well structured, is a better way to go about a trade, and I have more success with it. And because I trade on higher time frames, usually they don't have to be managed every second of my day.
Okay. So I'll summarize everything that you said in as simple a way as I can put it for our audience. What you're saying is if you enter a trade, it goes into drawdown, you add one or two positions and it starts going into profit. You essentially just look at the chart. You ask yourself if you think it's likely to continue to the quote final location that you think it might go. And then you will then make a discretionary decision that is in your subjective opinion as to whether or not you think it's a good idea to hold it or to close it. Does this sum up what you do?
Yes.
Okay. So there's no black and white thing that you'll look at. You've gotten enough experience to where you look at the chart and you just kind of ask yourself, like, does this look, quote, good? Does it look like it's likely to keep going? If the answer is yes, you'll hold it. Perhaps sometime you'll have your profit target met. And then if at any point it, quote, doesn't look good, then you'll just close it. And if that happens to be a profit or a break even or a loss or whatever, that will be that. Does this kind of sum up what you do?
Yes, very
Sweet.
much so.
Well, that's pretty clear, pretty straightforward. You're just using your experience to make decisions. This is nothing new. It's nothing magical. But I want to ask you, what if this doesn't go into profit? So this goes to the third location on your chart where you would add a position. And again, you pre-structured this from the moment you started to the moment you added. It gets to here. I'm gonna say what I think and what I assume you'll do is that you'll, assuming everything still looks, quote, good, and there's no crazy news events or anything that gives you pause for concern. In most situations, you would just add a third position. And then what you'll do from here is you will use this position and the distance from that to your initial final, quote, invalidation area, the position that you're just going to close all your trades at a loss. And you'll figure out how many pips that is, and then you'll risk $500 for that last trade. Does this sum up what you'd be likely to do?
Yeah,
Okay, cool. Then if price goes here, you lose $1,500.
correct.
I think a big point of contention a lot of people might have is the fact that the risk continues to be more and more as you're adding all the way to the final location that it gets to before it goes into profit potentially, or maybe ends in a break even or something. I want to ask you, based on your experience doing this over the past few months, what percentage of the time would you say that all your positions, all of them are wrong, all of them go to the final invalidation, and then you take that big loss. What percentage of the time is that?
It doesn't happen very often. And as of recent, I've had a trade like that recently that I actually ended up closing before it got to the invalidation point. Um, and again, it was something where I just decided to do that based on what I was seeing in the market at that point, as well as, and I know this is something that is poorly understood because it's just a feeling that we get when we look at charts, an intuition, or however you want to call it. But when I see something that just doesn't look to me any good anymore, I will close it even before it gets to invalidation points. So sometimes I am able to sustain a smaller loss than originally planned for. And yes, it's still a loss, but it is closed upon my discretion. And it's been a really long time now that any of my trades have actually hit a stop loss.
Okay. So if you were to take a guess at what percentage of the time these trades will actually end at the final invalidation in a total loss, what percentage of the time would you guess that's close to?
Maybe 5%.
Okay. So then what you're saying is you're saying that 95% of the outcomes in your trading end in either a net profit or a break even or something like that. Is this an accurate assumption?
That sounds about right.
Okay. Whenever you do take a quote big loss like this, 5% of the time, or whatever the metric happens to be, about how many good trading opportunities or how long do you think it's likely to take for you to make back what that loss is?
And that's really hard to say. Um, and I don't keep a journal. I don't document my trades anymore. I was doing that at the beginning, but I don't do it anymore. So it's hard for me to specifically say the truth and nothing but the truth. But just to kind of estimate, it would probably take three trades, three winning trades to make up for that loss. And that could be just three entries to make up for that loss, not necessarily three different trades.
Okay. So the answer is just like a couple of trades usually. Maybe it'll be
Correct.
one or two really good trades, where it went against you, you added, then it just goes into a huge profit. Or maybe it'll take you like potentially five trades, right? Maybe it just takes, you have some small winners, you have a break even, you have then a couple decent winners. Then you make back the loss and you continue. And I suppose what makes your trading approach profitable is the fact that the statistical likelihood of your trades ending in a net profit based on the risk structure and risk management dynamics that you use, it means that most of the time you're just going to end in probably a profit or a break even or something like that. And then you still accept that every now and then things will end in a loss, and those losses will be bigger than your average gain, but it happens such a small percentage of the time that it's negligible, not to mention the times that you can personally look at the chart and then sort of predict like this is likely to continue to that final invalidation. Therefore, I'm going to close here before that. And you're doing all of this in a perfectly structured way, and worst case scenario, when you start that first position, where you're likely going to add, what the total risk is, and if everything goes the wrong way and all your positions go into drawdown, you've already predetermined that exact loss and what that's going to look like. Does this all sum up everything in an honest and truthful way?
That's correct. And all of my risk that I'm assuming uh, is pre-planned in a way that I will try to never blow my account. Because that's the ultimate goal, is to keep working on it and to keep it viable.
Okay. From your statistics, to truly blow your account and reach the max drawdown limit, which I assume might be $5,000, what is your max daily drawdown limit?
It is 5% of the account. Yes. So $5,000 on a $100,000 account.
Okay. And the total drawdown you can assume at any given time is 10% or $10,000 on a 100K account.
On this particular one, it is 6%. So that's the total that I can lose.
So it's roughly close to your daily drawdown limit, which probably makes things simpler. So with this risk structure that you're using, you would have to lose 3 trades in a row that all go to drawdown to lose roughly $4,500, which would roughly get close to your daily drawdown limit and cause you to lose the challenge or to lose the funded account. And since the likelihood of that happening even one time is roughly 5%, even if we round it up, let's say it happens 10% of the time, the likelihood of that happening and you're completely wrong on 3 outcomes all in a row, back to back consecutively, that's 10% of the time multiplied by 3. It's such a diminishingly small percentage of the time. It means that for all intents and purposes, that it's just extremely unlikely to ever happen, if at all. Is this true?
That is the assumption. Of course, we can't predict what's going to happen, and there is always a risk that something like that might happen.
Cool. Um, you seem to have almost like a delusional level of confidence because you've pre-planned everything. You don't really have to do a lot of quote babysitting, and you kind of just seem to let things play out. Is this an accurate characterization of the way that you actually approach this?
It sounds really good, right? And it's not that simple. Of course, I will look at charts to make sure things are going well. And of course, I will question myself at times. Sometimes when things do take a turn for the good, there's always a risk of taking the profits too early because we really don't know for sure when a reversal versus just a pullback in a trade will happen. So there's a little nuances. I'm not nowhere near perfect, and I don't even call myself a trader just yet because at this point I'm just participating in the market, trying to figure things out for myself and trying to make this a full-time profession moving forward. Um, but it's not nearly as perfect as you just made it sound in that one sentence. There's little nuances to it, and a lot of times maybe I will just close everything just because of a hunch or something, and I will take a day to reassess things and do a lot of management to the individual trades because not everything goes as pre-planned as we like it to go. So for the most part, though, I was able to get rid of the bad habits and look at the smaller time frames and sometimes even a 1 minute chart that would then lead me to make a bad decision. So I do tend to try to my best ability to let things play out. But it's not as fancy as it sounds, right?
Yeah. Okay. Would you say that generally speaking, most of the time you're pretty peaceful in the discourse of your trading activities?
I sleep better. And that's one thing that I didn't used to do because before I kind of started following some rules and trying to discipline myself in a way, I was doing a lot of things that made me not sleep at night. I would be up, all the time worrying about my trades. because I was worried I would lose money. I was worried I would blow accounts or not pass challenges and so on and so forth. Now, for the most part, I sleep well because I know that the worst case scenario is what I have already predetermined. And I know this is going to sound confident, but even if I have a big losing trade, I am well aware that if I go back to what I have been doing for now about 9 months, things will work out and I will be able to fix it, fix whatever it is I broke. And as a free cent, that has happened once in a while. I will increase my risk. So once in a while, I will just tell myself, okay, so these last however many trades have worked out well. Now it's time to maybe double up on the risk so I can gain a little bit more money a little faster. Um, Recently, I upped my risk by uh, 4 times as much. I made that huge jump, and that first trade, as it always happened, traditionally went against me, and I lost a significant amount of money um, that I then had to fix. And as of, I think last week, I did that. But it took me because I had to scale back down and look at the risk structure again. I had to take, I think it was a total of 4 trades with 12 entries or something along those lines to fix what I broke. But knowing that most of the time what I'm doing works, I am confident or convinced that if I do things the right way, the predetermined way, I can undo whatever it is I did wrong, or a trade that just went, against me, because those happen too. It's part of trading. Um, we can control it, we can control the outcomes, and we can control what we do next. And that's another key to being successful, is not letting past traits affect you in a negative way, but just going back to what you have been doing, as long as whatever you're doing has been successful.
Mhm. Okay. To all of this, it sounds like to me that you seem to break a lot of very common practices and common ideologies that people say. Um, for example, when we just go and look at like your risk structure and the pre-planning of a trade and how you're going to manage the risk, you essentially just look at a chart and just take a guess as to what you think is going to happen, and it's all based on your quote feelings and intuition. Some would call this emotional trading. Other people would even take it as far as to say that you're just literally gambling and it's not grounded in anything whatsoever, and that you're going to blow up eventually. You're going to lose all your money. This is never going to work long term, and eventually you will join the basket of failed traders. And yet you do that. You just guess if you think it's going to go up or down. You do the unforgivable sin of adding to losing trades. And since each trade you treat it as an individual new entry, your position size continues to go up. So you're increasing your position size as it goes up. This first entry may be a 0.1. This one might be a 0.2. This one might be a 0.3, or whatever it happens to be. So other people would say that you're even martingale trading. And then at the same time, you're using a stop loss. But that final invalidation, even if it's a 1-to-1 risk reward ratio and you don't add, you'd have to target all the way down here just to have those profit targets hit. But you're probably not going to be holding it all the way to the profit target. If it's gone this far against you, then maybe it goes back somewhere down in here to your original entry. You've got all these in profit, then it starts kind of bouncing. You're probably going to be unlikely to try to hold it all the way there. And so what this means is if you do enter and then it does bounce at say your second entry and you close it down here, You might make, 300 or $400 on this, but you were risking a total of $1,500. So what this means is your average win is in general lower than your average loss. This becomes immediately apparent whenever you say, yeah, it takes me, maybe 3 trades on average to get back what I lost. Perhaps that can even be more. You said your last huge loss, it took 4 trades with a total of 12 individual positions to gain back the loss. So people are going to point the finger and say, you're just guessing. There's no structure. You're just gambling. It keeps going against you and you just keep adding. And you're martingale trading, which everybody knows martingale doesn't work. And even though you're using a stop loss, your average trade is lower than what your average loss is when you lose. And so even with your high win rate, it's less than a 1-to-1 risk reward ratio because you're making less on average than you're gaining. And then yet in the face of all of this, you have the audacity, Della, to sit there and tell me that this is all acceptable and this works for you. And it's been working for almost a year, and you have no intention of changing it, and you're going to continue doing it. Is this your position?
Yes, I will continue doing it until it doesn't work anymore. And my intention really for the future is not to just stick to one approach. I mean, in the last couple of months or so, I have been demoing other strategies or other ways of making money in the market because what I do now is what's if we're going to put a label on it, it's considered swing trading, and those things kind of take a while sometimes to play out. So I'm looking at finding other ways to make money in the market by, maybe going back to lower time frames and whatnot. Just trying different things to hopefully get really good at this moving forward and have more tools in my tool belt to utilize to make myself as successful as I can be. But for now, this is my best option. It's been working for a while now, and I do not have any intentions of stopping.
Yes. Okay. That's a very bold statement. And I mean, obviously, what you're doing is working for you. And you're in the small percentage of people that can actually trade profitable, which we know the statistics are less than 10% of people can even break even trading. And so whatever the metrics are, 1% of people are profitable, 30% are profitable, 10%, whatever the metrics are, you're in the small minority of people who are in fact making a profit. But we also have to compound that by the fact that you're actually doing this on a funded account and you're really having to structure the risk in a super specific way so as to not surpass the daily drawdown limit or even the max absolute drawdown limit period. You put all these things in place and you're somehow able to still do it almost a year into your trading profitability. We're at a little over 9 months right now. This puts you in the low single digits of people who are profitable to begin with and profitable trading a funded account because the statistics are it's about 0.25 to 0.5%. We're talking about 1/4 of 1% of people are able to consistently get payouts on funded accounts. You're able to do this, and you're able to do it seemingly breaking all the rules with trading. I want to get into the next part of this, which is where there are certain labels that people will throw around as to what type of trader they are. Some people will say that they are institutional, order block, liquidity, bank manipulation, distribution, fair value, accumulation gap, Wagyu beef, bullish entry, candlestick strategy trader. They will say they are a swing trader. They will say they are a scalper. They will say they are a trend trader. They will say they are a reversal trader. And whatever else mental gymnastics or stories we will tell ourselves that characterize the quote way someone trades. My question to you is, would you put yourself into any of those categories? And if so, what type of trader would you say you are? And if the answer is no, could you describe in as simple a way as you can what type of trader you are, quote unquote?
Well, since we do know that some of these definitions come with a certain label, I guess it would be the closest to a swing trader as it gets. because I do go off of high time frames, and I usually look for a significant movement in a trade. And I believe that is considered to be a swing trader. So if I had to put a label on it, that's what it would be.
A swing trader, okay. On average, how long do your trades generally take? On average, ballpark range.
About 2 to 3 weeks, sometimes even longer.
Okay, cool. I share your trade duration as well. You and me, as we know, we trade in a very similar way. Um,
Well,
yeah.
I've learned from the best.
If you're talking about me being the best, I'm far from accepting that term and that crown. However, it is clear that what you're doing specifically, sure, yeah, you've taken bits and pieces of the things that I do and you've put it into your own trading approach, and then you've contextualized it in a way that's applicationally specific to prop firms. That way you don't cross the daily drawdown limit. And that
Okay.
is really commendable. But you've taken all these things. One of the most interesting things that I see is that, you call yourself a swing trader. I see that you have taken sort of a hybrid combination amalgamation of things like dollar cost averaging, grid trading, a pseudo martingale approach. You don't necessarily double your next bet after every recovery trade, but you do, the position size does get increased, but it's just done in a calculated way. So part of it is like pseudo martingale. It's reminiscent of martingale, and yet you still use a hard stop. So meaning just the invalidation where you're going to close all your trades at a loss and accept the big loss every once in a while. And then you also use things such as like still having like an average win that is very consistent, but it's just not as big as what your average loss is whenever it does occur a small percentage of the time. It is as if you've taken bits and pieces from all these various, primarily various risk structures and risk management techniques, and then you've just melded them all, and you've got this little like welding mask on and you've welded them all together, and then you've blacksmithed them all and polished them up into this beautiful, super specific, subjectively implemented trading quote strategy that you use personally. And my main question here to the people that are going to be listening to this thinking like, that is so, there are so many ins and outs, it's so complicated, I don't get it. You've taken bits and pieces of things you've learned and you've created this trading approach. What would you suggest to other people that are trying to do the same thing? They're trying to get a trading approach to work for them in their time constraints, the trading capital they have, perhaps even they're trying to do it with a prop firm. What would you suggest to help people do essentially what you've done, which is to take all this information everywhere and put it into a trading approach that is profitable?
Well, a lot of it is just trying things over and over. Um, and maybe even just starting out, because this is how I started, is going to the basics of trading and starting with a high time frame, just to get a little bit more familiar as to how markets move. So I didn't do the thing that I think you suggest to your students and people who follow your channels. Is I didn't take a demo account and learned using that. I actually did that on a challenge account. Um, and I started doing things by just risking little amounts of money until I found something that I saw that I was able to repeat successfully. So starting out small, meaning risking a little bit at a time until you can pick up on something that works for you, being it a certain strategy or a certain pattern or whatever it is. I mean, there's so many things out there that you can trade successfully. Some people just look for an ascending triangle as their strategy in the markets and they just trade that. But it gets complicated when you start to mix different strategies and when you try to listen to other people and implement all at once. That's something that is definitely not working. And then the other thing too is if you are solely trying to take other people's trades without understanding them, that's another bad habit you're creating. So it's best to pick one thing that you might like and do it over and over again to see if it's going to work for you. And if it works, well, then you can start fine tuning and finding better ways to create better entries, to close positions at a better time, or whatever the case may be. But finding that one thing that you will be stuck with for a while until you can either prove yourself that it will work or it won't work. That's probably the best thing I can recommend.
Okay. So it sounds like what you're saying is just experiment, test, optimize around what seems to work, keep doing more of what works, do a little bit less of what doesn't, and then just let the experience allow a person to become profitable using their own unique trading approach that they've developed as a result of getting experience and testing.
Correct.
Wow. It seems as though in life you just have to get some experience doing something and then you just get better at doing it over time. That's so crazy. That's such an insane concept.
Yes, and again, I have to give you the credit for bringing me back into the markets. I was not trading Forex before I had the opportunity to watch your YouTube video and to start following your Telegram channel and following the products you had available. Your YouTube videos are very helpful if people can take the time to just study them first. And it doesn't have to be you, it can be whoever they choose to follow, right? But in my case, it was your YouTube videos that have been very helpful and that have made a true difference in how I approached this market. And everything that came later on was a result of me taking a step back, not trying to rush into the market just out of FOMO or whatever it may be the case, but taking things slowly, going back to basics, zooming out and going to higher time frames to gain some experience. And I really do recommend to anybody who is watching this to watch a particular YouTube video that you made last year. That was the video I watched after my husband sent it to me. And this was at a really bad time where I was ready to quit trading altogether. The video that I watched goes by the name How Learning to Just Relax Made Me Millions Trading. That video pretty much summarizes all the things I was doing wrong when I was trading with bad habits and bad practices. And that video was truly the beginning of me turning things around. And then I joined your group at some point, and I found a lot of support from you, from other people who were in the group, and a lot of things that have helped me on my trading journey. But in order for things to fall in place and for one to become profitable, it's not as easy as just doing one thing or just listening to one video. It takes a lot of work and a lot of learning to gain that experience, to see what's out there, to even look at different people, different YouTube videos, read different books about trading, and bring all of that knowledge into your locus of control, and then apply that to something that you're going to follow for a while and experience with, to truly get to a good place in trading.
That makes sense. I think there's a lot to be unpacked there. With the main overlying premise, it's just being held under the umbrella of just get experience and see what works. Yeah.
Yes.
Adela, is there anything you'd like to leave our audience with before we end this amazing video?
I would say if you are looking to seriously become a trader, be prepared to lose money. uh, don't believe the social media out there and all those flashing people who are not being transparent about what trading really comes with. Um, it's hard work. It's probably the hardest thing I have ever done in my life. Um, it is probably the most rewarding one as well at this point. And it is something that, as a result, I will do for the rest of my life. Um, but just be prepared for the downfalls as well. It's not as easy as it seems on a YouTube video. There will be a lot of ups and downs, and you have to go through them. That's how you gain experience. It's part of the process. And the bad things that come with it will make you, well, either break you, but there's a potential that they will make you a better trader down the road. So don't quit.
Fair enough. The thing I would add is something that you said a couple minutes ago, which is that you just went and you started using really small position sizing. And for other people, whether that's a demo account or a tiny live account with a balance they're completely comfortable losing if everything goes wrong. And then just using like the lowest position size, like for instance, like 0.01 lots, getting in where they think it might bounce at or might continue at. If it goes against them, maybe add at a point they think, okay, I was wrong on the first entry. Now it's gone all the way up to here. Maybe it's another resistance level, or maybe it's just made a higher high and you think, okay, it just made a higher high. It might be likely to pull back now. So then just adding to those and kind of seeing like what the ebbs and flows of the market to kind of get a little bit of that edge of intuition and discretion developed. I would say trading with small position sizing and just literally just doing whatever you want, watching what happens. That is also, just in my opinion, a really quick, easy, and less risky way, even if you're doing it with a small live account. It's a less risky way to accumulate that experience. So that then once you find out what seems to work, you can then continue doing more of that. And then once you kind of see like, okay, these are the kind of falls, the weaknesses, the quote, bad things that like you said you were doing in the beginning of the call. You can kind of learn what those are and where the weaknesses are. Then you can kind of be more self-aware to stop doing those. But as you said, it truly just boils down to just the longer you do it, the better you get, as long as you're learning from your mistakes and you're allowing that experience to shape your thought patterns and behavior patterns in such a way that it is conducive to profitability. Adela, thank you so much for taking this time out of your day to share this with myself and our audience.
Thank you for having me, Nick.